Hello, I'm David Hardesty, and in this lecture, we explore the tax rules for the sourcing of income. Sourcing is the key to taxation of inbound transactions because foreign persons are generally taxable in the United States only on U.S. source income. The objectives of this lecture are to understand the following: the effect of income classification on the selection of rules to source that income, and the sourcing rules under U.S. domestic tax law for the various types of income. Let's first discuss in broad terms the impact of the classification of income on the sourcing of that income. The income sourcing rules under U.S. domestic tax law are at sections 861 to 865. A quick review of these code sections reveals a plethora of different tax rules associated with different types of income. Different sourcing rules apply for each different type of income identified in the code. The importance of characterizing and sourcing income lies in the fact that under U.S. domestic tax law, a foreign person is usually subject to U.S. tax only on U.S. source income. This is the case even if a U.S. tax treaty applies, because a foreign person must first have U.S. source income before there is a potential for tax. Here's an example of the impact of U.S. source income. Jones is a citizen and resident of country X, a country that does not have a tax treaty with the United States. Jones owns stock in Foreign Corp, a country X corporation that is engaged in the conduct of a U.S. trade or business. Its effectively connected income accounts for 35% of its worldwide income. Accordingly, as discussed in the lecture on non-business income, 35% of the dividends paid to Jones by Foreign Corp are U.S. source income, and Jones is taxable in the United States only on that portion of the dividends that is U.S. source income. Here are the broad categories of income identified in the sourcing rules, which we will cover in this lecture. You will note that there are other sourcing rules for other types of income, which we will not be covering in this lecture. Interest income, dividend income, personal services income, rent and royalty income, income from disposition of a U.S. real property interest, inventory sales, and sales of other personal property, including sales of intangible assets. Let us begin with interest income. Interest received is U.S. source income if it is paid by the United States or the District of Columbia, it is paid by a non-corporate resident of the United States, or it is paid by a domestic corporation. Here's an example of the sourcing of interest income. Domestic Co. is a U.S. corporation that issues a $10 million bond. Albert, a country X resident, purchases 1 million of this bond. Domestico uses the proceeds from the bond issuance to acquire business assets used in country Y. Interest income on that bond is U.S. source income. There are exceptions to the general rule for sourcing of interest income. Interest paid on deposits with a foreign branch of a domestic corporation or partnership engaged in commercial banking is not U.S. source income. Although interest paid by a foreign corporation is ordinarily not U.S. source, interest paid by a U.S. trade or business of a foreign corporation is U.S. source under the branch interest tax rule. This rule is discussed in the lecture on the branch profits tax. Interest paid by a foreign partnership is not U.S. source income if the partnership is predominantly engaged in an active conduct of a trade or business outside the United States, and the interest is not either paid by the U.S. trade or business or allocable to effectively connected income. Here's an example of the source of interest income received from a foreign partnership. Foreign Co. Limited is a Country X partnership that is engaged primarily in an active business in Country X. However, it has a U.S. operation that constitutes a U.S. trade or business. Interest paid by that U.S. trade or business is U.S. source income. In addition, if any of Foreign Co.'s worldwide debt is allocable to U.S. source income, that is, effectively connected income, then that allocable interest is also U.S. source. Tax treaties can provide alternative rules for sourcing income. As a general rule, interest is taxable only by the state of residence. However, contingent interest, which is determined with reference to sales, changes in property value, or other determinants other than simple interest rate, can be sourced in the country from which the interest arises. If the beneficial owner of the interest carries on business through a permanent establishment in the United States, and the interest is attributable to that permanent establishment, then the interest is taxed as business profits attributable to a permanent establishment, and the United States may retain the right to tax that income. Here's an example of the modification of the interest sourcing rules by U.S. tax treaties. Foreign Corp., a Country X corporation and resident, makes a loan to Domestico, a U.S. corporation. Ordinarily, the interest is taxed only in Country X. However, the interest in this case is contingent upon the increase in value of U.S. property owned by Domestico. This contingent interest can be taxed in the United States. Now let's turn to dividend income. Dividends paid by a domestic corporation generally result in U.S. source income, and dividends paid by a foreign corporation generally result in foreign source income. However, there are several exceptions to these general rules. As an exception, dividends from a foreign corporation can be U.S. source if at least 25% of the company's gross income is effectively connected. This rule is explained later in this lecture. Dividends from a foreign corporation are U.S. source if they are distributed from the earnings and profits of an inherited domestic corporation. Dividends received from a foreign corporation can be U.S. source for the special purposes of the dividends received deduction and the foreign tax credit if certain requirements are met. This discussion of dividend income is continued on the next slide. Dividends do not include non-dividend distributions from corporations. The sourcing rules in section 861 refer to dividends. This term is defined by section 316 and refers to distributions to shareholders which are not liquidating distributions or distributions to redeem stock, except to the extent these latter distributions are specifically classified as distributions. The sourcing rules for dividends do not apply to these other non-dividend distributions. If a domestic corporation is an existing 80-20 corporation, then a portion of its dividends may not be U.S. source income. Income tax treaties generally do not apply specific sourcing rules for dividends. Here's an example of a dividend from a domestic corporation. Matthews is a citizen and resident of Country X who receives a dividend from Domestico, a U.S. corporation. Domestico earns 90% of its revenues from foreign sources. Assuming Domestico is not an existing 80-20 corporation, the entire dividend is U.S. source income despite the fact that the corporation earns its income from foreign sources. As noted earlier, dividends from a foreign corporation can be partly U.S. source income under the 25% rule. As an exception to the general rule, dividends from foreign corporations can be U.S. source if the following requirements are met. At least 25% of a foreign corporation's gross income during the preceding 3 years is effectively connected with a U.S. trade or business. Here's an example of the sourcing of dividends from a foreign corporation. In 2010, Foreign Corp, a Country X corporation, pays a cash dividend of $10,000. For the 3-year period ending with 2009, Foreign Corp has been engaged in a trade or business in the United States and has received gross income effectively connected with the conduct of that trade or business amounting to 80% of its gross income from all sources for the period. Of the total dividend, $8,000 is treated as income from sources within the United States. Now let us look at the difficult problem of sourcing income from services. We will start with the sourcing rules for the performance of personal services by non-employees or corporate or companies. Compensation for the performance of services by a company or non-employee is sourced to the country where the services are physically performed. The residence of the person or entity performing the services is ordinarily not relevant to the sourcing of the income. Where compensation is for services performed partly inside and partly outside the United States by either a company or non-employee individual, the income must be allocated in a manner that best reflects the income's source. Here's an example of services performed by a company. Domestico is a U.S. corporation that receives compensation of $150,000 for services performed in the United States and several foreign countries by numerous of its employees on a single contract. The time spent on the contract by employees performing personal services outside of the United States equals the time spent by employees performing services inside the United States. However, the payroll cost for employees performing services in the United States is $20,000 out of the total payroll cost for the entire contract of $30,000. Under these facts, sourcing of income based on a relative payroll cost most accurately reflects the proper source of the income received. Therefore, U.S. source income under the contract is $100,000, and the remaining $50,000 is foreign source. Let us turn to the sourcing rules that apply for services performed by employees. Income from personal services performed by employees is generally sourced where the services are performed. This is the same rule as that which applies to companies and non-employees. The residence of the person performing the services is ordinarily not relevant to the sourcing of the income. Income earned by an employee for services performed both in the United States and outside the United States is ordinarily allocated to U.S. and foreign sources based upon time spent performing services inside and outside the United States. A minor exception to the sourcing rules applies for a compensation of $3,000 or less where the person is present in the United States for no more than 90 days and the services are performed for a foreign person or a foreign branch of a U.S. person. In this case, compensation for services is not considered U.S. source income. U.S. tax treaties can make compensation received by a foreign employee tax-free in the United States for presence of up to 183 days in the United States. However, this rule does not affect the source of the compensation. This rule is discussed in the lecture on the taxation of business income under U.S. tax treaties. A special problem involves deferred or advanced compensation where a person performs services in one year but is paid in another. Generally, a foreign service provider is taxed in the United States in the year of receipt of compensation based on the services performed in the United States in another taxable year. When compensation of a non-resident alien individual or foreign corporation is taken into account for any taxable year, but the income is attributable to the performance of services in another taxable year, the determination of whether such compensation is taxable under Section 871B or 882 is made as if such income were taken into account in such other taxable year, without regard to the requirement that the taxpayer be engaged in a U.S. trade or business during the year the income is actually received. In the case of compensation for personal services performed partly within and partly without the United States by an individual as an employee, the part of such compensation that is attributable to services performed within the United States and that is therefore included as gross income from sources within the United States is determined on a time basis. Here is an example involving stock options. Jones was granted non-vested options to purchase 100 shares on 1106 with an exercise price of $1. The options vested ratably over 5 years and became fully vested on December 31, 2010. During this 5-year vesting period, the employee worked in the United States for 3.5 years. The options were exercised on 12/31/12 when the stock was worth $6. Of the $500 of compensation recognized, 7/10, that is $350, is U.S. source income because 7/10 of the vesting period was spent working in the United States. Special rules apply for the sourcing of fringe benefits. Fringe benefits applicable to employees are ordinarily sourced on the same basis as regular wages. However, special sourcing rules apply for particular fringe benefits. Housing, transportation, and education benefits are sourced to the taxpayer's principal place of work. Tax reimbursements are sourced to the jurisdiction that imposes the tax. Hardship or hazard pay is sourced to the location for which the compensation is paid. Moving expenses are sourced to the new principal place of work. And qualified retirement plan benefits are sourced based on extensive rules provided by the IRS, which we will not discuss here. Here's an example of the sourcing of employee compensation. Jones is an employee of Domestico, a U.S. corporation. Jones provides consulting services both inside and outside the United States during the period March 1 to December 2025, a total of 300 days, and receives compensation of $80,000 for this period. Jones is on call on a 7-day-per-week basis, so is deemed to work on each of the 300 days. Jones performed services, or was available to perform services, within the United States for 180 days and outside of the United States for 120 days. Jones must include in income from sources within the United States $48,000, $80,000 times 180 over 300. This example is continued on the next slide. Jones also receives reimbursement for education expenses. His principal place of employment is the United States, so all of the education reimbursement will be sourced to the United States. The next category of income is rentals and leases of tangible property. Rents from leases of tangible personal property are generally sourced where the property is located when it is used. Special rules apply to the rental income from railroad rolling stock, which is U.S. source income if the expected use of the property is the United States. Here's an example of the rental of tangible property. Foreign Corp is a Country X corporation that owns oil well drilling equipment, which it leases to oil companies in Texas. All of the lease income is U.S. source income because that is where the property is used. Now let us discuss the sourcing rules for royalties received from licenses of intangibles. Royalties from licenses of intangibles are sourced where the intangibles are used. If intangibles are licensed for use both within and without the United States, then income is sourced to the United States based on the extent of U.S. use relative to total use. Here's an example of the sourcing of royalties from intangibles. F1 is a foreign corporation and the holder of software copyright X. F1 licenses the copyright to F2, another foreign corporation. F2 sublicenses the copyright to Domestic Co. for use in producing software X for sales to U.S. customers. In a case similar to this, the royalties from Domestic Co. were U.S. source income, but the royalties from F2 to F1 did not retain their character as U.S. source income. Next, we look at income from disposition of U.S. real property interests. A disposition of a direct interest in real property located in the United States generates U.S. source income. In addition, the disposition of a U.S. real property interest, which can include stock in a corporation that holds U.S. real property, is also U.S. source income. The rules for dispositions of U.S. real property interests are discussed in another lecture. Let's now turn to sales of inventory. The sourcing of receipts from inventory sales depends on whether the seller only purchases and sells the inventory or whether the seller both produces and sells the inventory. Where a vendor purchases and resells inventory, the source of the sale is the country where the sale takes place, which is ordinarily the place where the rights, title, and interest in the property are transferred to the buyer. For most inventory sales, this will be where the property is delivered. Where a company produces inventory in the United States and sells it outside the United States, or produces it outside the United States and sells it within the United States, income is from sources partly within and partly without the United States. Prior to 2018, the default method of sourcing income was the 50-50 method. Under this method, 50% of the sale was sourced to the place where inventory was produced and 50% to the place where it was sold. Prior to 2018, an alternative method was the IFP method. IFP stands for Independent Factory Price. Income was allocated within and without the United States by allocating income to the country of production based on a fairly established factory price. Also prior to 2018, under the Books and Records method, with permission of the IRS, the taxpayer could allocate income by accounting for it on his books and records using receipts and expenditures in a way that clearly reflected income from production and sales activities. After 2017, income from the sale of produced inventory was or is sourced to the country or countries of production. Here's an example of the purchase and resale of inventory. Foreign Corp is a Country X seller of software. It purchases all of the software that it sells from Country X software producers. It sells the inventory through its website. The website is operated from Foreign Corp's Country X offices. Foreign Corp's U.S. source income from these sales equals the gross sales price from software delivered to U.S. customers.
Here is a pre-2018 example of the allocation of income from the production and sale of inventory using the IFP method. Domestic-Co is a U.S. producer of cloth, which it sells to Foreign Corp in 2017 for $100. Foreign Corp is a Country X company. Domestic-Co does not engage in significant sales activities in the sales to Foreign Corp. Under these facts, the sale fairly establishes an IFP, independent factory price, of $100. If Domestic-Co elects to use the IFP method, $100 of the gross sales price is treated as attributable to production activities, and no amount of income from the sale is attributable to sales activities. After reducing the gross sales price by Domestic-Co's cost of goods sold of $80, $20 of the income is treated as attributable to production activities. This example is continued on the next slide. Domestic-Co also sells cloth in Country X to an unrelated foreign buyer for $110. If Domestic-Co elects the IFP method and the cloth is substantially similar to the cloth sold to Foreign Corp, the IFP method must be used to determine the amount attributable to production activities in the $110 sale. Accordingly, $100 of the gross sales price is treated as attributable to production activity, and $10 is attributable to sales activity. After reducing the gross sales price by the cost of goods sold, $20 of the income is treated as attributable to production activity, and $10 is attributable to sales activity. For years after 2017, there's only one method of sourcing sales of inventory produced by the taxpayer. For the sale or exchange of inventory property produced in whole or in part by the taxpayer within and sold or exchanged without the United States, or produced in whole or in part by the taxpayer without and sold or exchanged within the United States, income from the sale or exchange of the inventory must be allocated and apportioned between sources within and without the United States solely on the basis of production activities with respect to the property.
As an exception to the general rules for inventory sales, certain foreign sales of inventory by foreign persons can result in U.S. source income if they are made from a fixed place of business in the United States. Section 865A2 provides that a foreign person's sale of inventory outside the United States is U.S. source income if it is attributable to a fixed place of business in the United States. However, this rule does not apply where the sale is made for the use, disposition, or consumption outside of the United States, and a foreign fixed place of business of the foreign person materially participates in the sale. Here's an example of inventory sales from a fixed place of business. Foreign Corp is a Country X corporation engaged in sales of corn products produced on farms in the United States. The company has offices all over the world, including the United States. Its U.S. office constitutes a fixed place of business. As a general rule, all sales made from the U.S. office, regardless of whether they are foreign or domestic sales, result in U.S. source income. However, if foreign offices of Foreign Corp materially participate in these foreign sales, then the sales do not automatically result in U.S. source income.
A similar rule for inventory sales from a fixed place of business applies to certain non-resident aliens. The rule described in the previous slide is at section 865E2, and a similar rule exists at section 864C4B, but applies only to non-resident aliens classified as U.S. residents under section 865G. Where this special rule applies, it supersedes section 865E2. Where this rule applies, it causes foreign inventory sales from a fixed place of business to be treated as effectively connected income. A non-resident alien can be classified as a U.S. resident under Section 865G when the individual has a tax home in the United States. For example, a student may be exempt from the substantial presence test, but could qualify as a U.S. resident under Section 865G. Here is an example of the special rule for inventory sales from a fixed place of business that applies to certain non-resident aliens. Jones is a country X citizen and full-time student in the United States. Jones is exempt under the substantial presence test and is therefore classified as a non-resident alien. Jones starts a business from a fixed place of business in the United States, selling inventory to customers outside the United States. As a person with a U.S. tax home, Jones is a U.S. resident under Section 865G, and Section 865E2 does not apply. However, Section 864C4B applies, and foreign sales of inventory are classified as effectively connected income.
A dependent agent in the United States can cause a foreign person to have a fixed place of business. In applying the provisions of both Section 864C4B and Section 865E2, a dependent agent in the United States can cause a foreign person to have a fixed place of business. The terms dependent and independent agents are defined in the regulations. An independent agent will not cause a fixed place of business. A dependent agent is an agent that is economically dependent on the foreign person, has and habitually exercises the power to make contracts on behalf of the foreign person, and is not an independent agent making sales in the ordinary course of business. You may recall that the terms dependent and independent agent have come up previously in this course. We studied them in tax treaties. The dependent and independent agent definitions are nearly identical in U.S. domestic tax law to those in U.S. tax treaties. However, there are important differences. Under tax treaties, the terms are used to determine if there is an agency permanent establishment in the United States. Under domestic tax law, the terms are used to determine if there's a fixed place of business. Under treaties, a dependent agent can create a permanent establishment even if the agent does not have a fixed place of business. Under domestic law, a dependent agent that creates a fixed place of business must obviously have a fixed place of business. Section 864C4B, which we have been discussing, also applies to a few other types of income. When attributable to a U.S. fixed place of business, the following foreign source income can be effectively connected. Foreign source rents or royalties for use of intangible property derived in the active conduct of the trade or business. Dividends, interest, and amounts received for debt guarantees in connection with a banking or similar business or a business engaged in trading stocks or securities for its own account. Note that for these types of income, participation of a foreign office does not prevent the income from being effectively connected. Let us now turn to the sourcing of sales of other personal property, which can include both tangible and intangible personal property. As a general rule, personal property other than inventory is sourced to the seller's country of residence. That is, a sale by a U.S. resident is sourced in the United States, and a sale by a foreign resident is not sourced in the United States. This rule applies to sales of both tangible and intangible property. Now for the exceptions. Where there is a transfer of depreciable property, then gain equal to prior depreciation is sourced in the country based on the proportion depreciation taken in that country bears to total depreciation. For example, if gain attributable to prior depreciation is $100 and 70% of the depreciation was deducted in the United States, then 70% of the gain is sourced in the United States. Any gain in excess of depreciation is sourced using the inventory rules discussed earlier. Where a transfer of an intangible is treated as the disposition of personal property, and the intangible was subject to amortization, then gain equal to prior amortization is sourced in the country to which the amortization applies. That is, the country in which the intangible was being used while it was being amortized. Any remaining gain is sourced to the seller's residence based on the general rule. This rule is pretty much the same as the rule for depreciation, except that the gain in excess of amortization is sourced based on seller residence. Note that if the sales price of an intangible is based on the use or productivity of the intangible, then the rules for sales of personal property do not apply. Instead, the rules for sourcing income from licenses of intangibles will apply.
Section 865E2, discussed in a previous slide in relation to the sourcing to the U.S. of forward inventory sales, where those sales are attributable to a U.S. fixed place of business, applies to all personal property sales. Accordingly, sales of personal property other than inventory can be sourced to the United States, even when such sales are consummated in a foreign country.
Here's an example of the sourcing of the sale of depreciable property. Foreign Corp is a Country X corporation and the owner of a shipping container. The shipping container costs $1,000 and Foreign Corp has taken $600 of depreciation. It sells the container for $1,100, recognizing a gain of $700. The sale takes place in country X. Of the $600 of depreciation, $400, or 67%, was allocated to the use in the United States and was deducted in determining effectively connected income. Gain equal to the U.S. depreciation, $400, is U.S. source income. Gain equal to the $200 of non-U.S. depreciation is foreign source income. The remaining gain of $100 is sourced to the country of sale, which is country X.